Welcome everyone to episode 1 of the Complete Forex Trading Masterclass. If you have always wanted to understand how global financial markets work, how currency pairs move, and how real wealth is generated through trading, you are in the right place. This is not a quick get-rich scheme video. This is a structured step-by-step professional academic course. We are starting from absolutely zero today. By the end of this series, you will be able to understand the market better than most retail traders. Let's dive straight into the first slide. The Complete Forex Trading Masterclass, Episode 1. What is Forex and how does it move? What is Forex? Foreign exchange market, the largest financial market in the world, traded over 7.5 trillion traded every single day. Global network of banks, brokers, and institutions. Let's break down the first word. Forex stands for foreign exchange. It is simply the global marketplace where fiat currencies are exchanged against one another. Put it size into perspective, the stock market trades billions a day, but the forex market trades over $7.5 trillion every single day. It's completely decentralized, meaning there is no single physical building. You know what I mean? This is a massive digital network run by global central banks, commercial institutions, hedge funds, and real brokers like us. Money is how money is made. The currency pairs mechanics. I want you guys to focus here. I want you to focus here, because this is how money is made. Because most of the time you people, they ask how are these things, are they those things scam? Who is controlling this, and how do we really make money in the market? Here we are. Currencies are always traded in pairs. For example, Euro USD, the base currency first versus the quote currency second. Buying, meaning long, equals betting the base currency gets stronger, and selling, in short term we call it short, equals to betting the base currency gets weak. In forex, you can never just buy a single currency. You are always trading one economy against another, which is why everything is displayed as a currency pair. Look at this example on the screen. Euro USD, this first currency is euro, is called the base currency. The second one is the US dollar, the quote currency. When you hit buy on your screen, you are projecting that the euro will grow stronger than the dollar. If you hit sell, you are projecting that the euro will drop while the dollar gets stronger. You can make money when the market rises, and you can make money when the market falls, as long as you are on the right side of the economy trend. Then another thing we're going to study about market structure and circles. We trade 24 hours 5 days a week, like the market hours, trading sessions. The market is open 24 hours a day, 5 days a week. And there are 3 major global sessions. The Asian sessions, where we have Tokyo, Sweden, low volatility, most of the time it consolidates. Then EU, we have London session, high volume, trend institution. Then US, where we have New York session, maximum volume and heavy reversals. Unlike the stock market, which shuts down in the afternoon, forex operates 24 hours a day, 5 days a week, because global business never stops. However, the market does not move with the same energy all the day. It flows through 3 main sessions. The Asian session is typically quiet and builds a range. And then the London session opens, bringing massive institutional volume from Europe, which often starts with the real trend of the day. Finally, the New York session overlaps with London, creating the most volatile high volume environment where massive market moves happen. And now here we go, calculating the market moves, pips and lot size. How do we manage how do we determine how much money am I going to make, how much money am I willing to lose, and all that we are going to be covering these things, because you have to understand and know how these things work, like calculating the market movements, because you're not going to say like from here to there I have traded these dollars. No, there's the way how we measure price, pips, and lot size. Pip means percentage in profit, the fourth decimal place movement. For example, euro US dollar moves from 1.1000 to 1.1050 equals 50 pips. Lot size, volume control of your trade. We have three how we manage to calculate or to know lot sizes. There is micro lot, min lot, and standard. The micro lot is 0.01, which equals to US dollar 0.10% per pip. Min lot is equals to 0.10 equals to $1.00 per pip. Standard lot size, this one equals to 1.00, which equals to 10 US dollars per pip. So you have to understand these things, because you will just open your trading and just put in the lot size not knowing, and boom, all of a sudden your account is wiped out. It can be against, it can be of advantage and of a disadvantage, but it's better when you know how these things work, or you try to understand what you're doing, because you'll be having a 10, let's say $100 US account, and you're trading standard lot size. It's impossible. It will move just like a little bit, a few pips, and your account is swept or blown. So it's better to understand how these things work, such that you know the risk. How am I risking? Why am I trading this? Like, you understand all this. Like, if I'm trading a min lot size on this certain account, how much am I willing to lose? Yes. Now let's talk about the actual math of how you calculate your profit or loss. We don't say the market went up 50 cents. We measure movement in pips. A pip is typically the fourth decimal digit on your chart. As you can see in the example on the slide, if your exchange rate of euro US dollar moves from 1.100 to 1.0150, that is 50 pip increase. To choose how much money each pip is worth to your account, you select a lot size before entering a trade. If you use a micro lot, that 50 pip move makes you $5. If you use a standard lot, that exact same 50 pip movement makes you $500. This is why risk management is the most important skill you will learn in this course. And now we go further and further deeper to understand how these things work, understanding the Japanese candlestick. Now guys, like we can all see, I've not drawn here the things, but like we can all see these things we draw. There is the candlestick charts, there is the bar charts and all that, but for most forex traders we use the candlestick, the Japanese candlestick. So reading the price, Candlestick Anatomy, the bullish candle, or what we normally say as green, the price closed higher than it opened. Then bearish candle, or red, the price closed lower than it opened. Then the body, the real trading volume between open and close. The wicks, or what we call shadows, highs and lows representing the price rejection. What am I trying to mean here? Like the price opened, let's say for the bullish, the price opened from down, it went up. But during that same time, the price managed to come down lower than where it opened from. But it did not manage to close from there. It managed to come up back and went up further. But again, it didn't manage to close from there up. It came back and closed like in the middle. So these things that we see up and down like sticks, those are what we call wicks. So let me hope you got me right. To read the chart, you must understand the language of candlesticks, Japanese candlesticks. Each candle represents a specific time frame, like 1 hour or one day. A green candle means buyers pushing the market up. A red candle means sellers drove it down. The solid box in the middle is the body, showing exactly where price opened and closed, but pay close attention to these thin lines at the top and bottom called wicks. Wicks tell us the highest and lowest points price reached during that time before being pushed back. Wicks represent price rejections and they hold the keys to finding where big orders are hidden. We continue. So that's all guys, but in the next video or in the next episode I will be showing on the charts on how these things work, like I show you the real thing, like on the charts and what. So stay tuned guys. By the end of this series you will be able to understand and know how these things work. So stay tuned, subscribe, like and follow for more. Bye bye.